This is Justin Pulitzer. This is my weekend review video for Sunday, October 9th, 2016. However, it is being filmed on Saturday the 8th. There's a lot to cover. I'm going to jump into the economic data first because I think that the Fed obviously weighs very heavily on the market what they will and won't do. So we've had some data that's come out in the last week or so. We had ISMs and PMIs, a bit of a mixed bag there. While there was a bit of a rebound, the ground it's on is rather shaky. The new orders are not doing so well. Backlogs are kind of holding up. So I guess that's kind of buffered the situation. But underneath, I have mentioned that I thought the employment was rather weak. And that played out in the non-farm payroll number this week. And you can see there was a revision higher in this NFP, but the prior reading before that, the July, this is the August revision, was a revision down. So those two kind of cancel out. And this one here was a chunky miss. Buried within there was, again, a bit of a mixed bag. Keep in mind, we had the miss. The labor participation rate upticked just so much. Hourly wages kind of upticked just a little bit, but below the July number. The work week, we know, ticked up a bit. It was like 34.3. It went up to 34.4, basically a rounding error. Still below the full time of 40 hours per week. Companies are avoiding the Obamacare tax. They are part-timing. I know this also from people I'm friendly with who tell me a very similar story in real-world applications, not just cold numbers from news agencies. This being, of course, from Bloomberg. Digging within the numbers, that bears out the case. We had temporary help was up to 23,000 jobs. The construction jobs were surprisingly up, although we had that mild winter and real estate projects have been going fairly well with the low interest rates. Retail had a bit of an uptick. Government was down and manufacturing, of course, was down. I had mentioned that within the ISMs. I guess the number here was an overall miss because we didn't have those coveted Carnival ride operator jobs to make up for the shortfall. Anyway, my thesis on this is that these numbers, while crappy and really just middling at best, should really have the Fed on hold. I think what got the market in a bit of a tizzy early on, though, was the probability of a rate hike. Well, the November number pretty much fell off a cliff. We're in single digits, and that seems, this is from the CME website. It seems very unlikely, only about 8.3%. However, December did uptick to about 60%. I think at the worst of this, during the kind of the down move on Friday, this was close to 60, I want to say 66%. 100% though was at 64, and it cut that jump in about half. So the market is here factoring in that there is likely going to be a December rate hike. That's the story with that, and that's played out quite well. I'll get into XLU and all that stuff a little bit later. My vision on this, though, is that the Fed, there's really no impetus. There's really no rush for the Fed to go. There's really very little inflation. Stan Fisher, who has been a rather kind of vocal member of the FOMC, he's Yellen's right-hand man. He's the number 2 there. He proposed that he's worried that the world economies are slipping into stagnant growth and that there might be a low interest rate for even longer. He's been the one who's been kind of amping the markets, getting us thinking that there's going to be a hike. And Loretta Mester and the Esther George, I'm joking around lately. I've been calling Loretta Mester, I've been calling her Mean Red. She came on shortly after the unemployment numbers and basically tried to put lipstick on a pig and saying things are okay, that it's time to hike. I think the Fed is better off just kind of chilling and letting the market kind of try to recover a bit. The The world is in easing mode, and the Fed just being neutral is more hawkish. If they were to move into a hiking stance, that would be not good. We know that the Italian banks are having trouble. We know Deutsche Bank is likely having issues. It just seems to me that the Fed should try to do no harm and just chill. We'll see how that plays out. I am of the camp that it should be lower for longer. I've said for a while, though, that they may move in December. They shouldn't, but they may. We'll have to see how that plays out. So yeah, that's the macro backdrop. It just seems to me that peripheral markets are kind of not doing so well, and the Fed would be basically pouring gasoline on that fire by hiking interest rates. We've seen when they tapped on the brakes last year around December what happened. Basically, the rest of the world went through a windshield. So I think they're very mindful of that. I know they're looking into other methods of QE, buying stocks and so forth. They just really should stay on hold. Will they? I can't tell you for certain. I've said all year I thought that we were lower for longer, except December could be a move. I will give you my read on that as we get closer and closer to the situation. All right, so let's get into the 7 market keys. So there's some mixed signals happening in the market right now. IV, we've had some violent moves with inside of a narrow range. A couple days ago, the market was moving up and down 10 points. I think that was on Wednesday. And the VIX is really not bearing that out. I mean, the VIX is rather low here still. You can see we are still in purely directional play here, meaning outright buying calls, outright buying puts, or spreads. My theory here is that this is just going to kind of bounce around. It's going to pull one of these with these momentary spikes. If there is some angst going into the Fed decision, we could get one of these kind of volatility upticks and test into these like 20s and 21s, the backside of the this potential old uptrend line. It's been we've had some moves into it, but the last time rejected. So, until we start really getting through some key levels, I think that we're just in one of these situations. So targets would be here, of course, 1785, and to the upside would be roughly 2021s. That's usually where things go. If this were to break, we could see those 25s and 31s, and of course get really kind of cray if the Fed were to hike. I don't know that the Fed is going to hike or that they won't, but as long as the Fed funds futures are pricing in the hike, you have to consider that it will. One of the things that are pointing toward a more hawkish Fed is this dollar situation. And I've said for a while that this could be the biggest risk to the markets all year. It basically had this gap up. We're over the 200 MA, and now we're kind of roughly with a bit of a look above and fail, or a look above and, kind of just chop. It's encouraging to me that the dollar didn't close on the highs and was a little weak into the close on Friday with this topping tail. But as long as we're above this 200 MA, we have to be a little cautious and vigilant. If this breaks, we could easily fill up here to the 25-23. As long as we're below here, I don't think the shit hits the fan. Sorry to be so blunt, but things could get a little dicey. If we break this, then I'm going to say the dollar is likely in a new up phase, and it's going to be a problem. The market will not like that. It's already showing you it's a little temperamental even as the dollar rises up. So I had proposed that we had this kind of head and shoulders potential, making a wedge, and the wedge is now broken higher. I wouldn't be surprised to see this kind of come back and retest the breakout, but I am very cautious on the dollar as long as we are above the 200 MA, and everybody should be mindful of that. The rise in the dollar has absolutely wreaked havoc in the precious metals. Gold is getting slazammed. We broke the range here to the downside. It's actually something I have been calling for, and we took out the 61.8 of the range. We're at the 78.6 of the range. You can see of the entire range, we haven't even gotten to half back, which is really the volume, kind of where the volume distribution is. So I'll tell you this. You can use Friday's range since it was such a wild trader, and it's roughly the 200 MA as a gauge. If you get below the low of the 118.42, I think we're going to come back down into these 115s. I think between the 115s and the 112s, which is the big 61.8 of the entire range, and this is kind of near where the breakout took place and these reference lows, that would be a great area to sell out of the money puts into. If we can get above Friday's high, which is going to be 120.58, I think that this could probably come back and at least test the top of the gap around 123s. So I'm either looking for a row short below Friday's low or a row long above Friday's high. I'm kind of just been on hold with this for a while, seeing how this plays out. But as we do come into these lower range area, if we can get, listen, it's conceivable we have the bounce and then the rollover, but I'd really be more interested into the lower end of this range. Gold likes to be very technical. It likes to get 61.8 retracements. This here area, if we, particularly if it's sharper, to me sets up really well. Same kind of thing with silver. Silver has been a little bit more bullish than gold. It held. Now you have a. Let's zoom in a little more. I could see. I wanted to say that this was a bit of a rounding experience. I wound up booking a lot of profits into this move. I had been long from like 14s, and now we're coming back down. The 200 MA here is held now, basically of, let me zoom in even further. You basically have tweezer bottoms here, so if you lose the tweezers, I think we're coming back down into this 61.8 of the 1559 to this kind of low area 1504, which I would be interested in. Could kind of see where this was the breakout. I'd be real interested in kind of buying the dip there. For the very least, at least it would set up for like kind of a head and shoulders, so you could play it for a move back to the 17s. I'm going to say the exact same thing I said with gold. You have two lows here. If you lose the lows, it's a right or right out short for a move still lower. Above Friday's high, though, I think could be a bounce back at least to the 100 MA, kind of this distribution, where the beginning of this distribution is the 17s where it broke down from. So that's my take on the precious metals. Bonds. So we had a bit of a look above and fail. I've been saying I thought we were coming back down to the channel low. That is what's taking place. The picture here is a little less clear. We have now two lows. This stop just shy of the 200 MA and this channel low and this bigger up channel low. So I'm thinking that this either is in the process of bottoming here, is basically a retest, or we might go a little lower and then bottom into this range, somewhere in the 30s to 31s. But I'm thinking that there's probably going to be a long setup in TLT soon. If this were to snap, I mean, I guess we could come back down to 127s, but I'm thinking that this uptrend at the very least is a good right or right out type of a play. So I'm looking to kind of buy the bonds soon into this move. Again, like I've said for a while, the PE multiple on the S&P is very dependent on bonds. This had a breakdown, a failed check back, and now we're retesting this low. So this area really needs to hold. If this were to snap and we were to fill up down to this trend, down to the 100% retracement of the 127s, the market isn't gonna like it. But I've for a while said that I think this area holds, and that's kind of my story, and I'm sticking to it for now. The yield plays have been savaged. You can see I drew in a bit of a regression channel here, and we're below the low and below the 200. I wouldn't be surprised to see a bit of a snapback in this just because it's come so far so fast, but we are making lower highs and lower lows. I would be more interested near where this volume distribution is and sort of where this consolidation breakout was, since we're below the 200. So I'm thinking that this could bounce, but it'll probably be a short. I'd be more into buying down near between the 61.8 and the trend, somewhere in the 45s to 44s. That area, I think, will be a good reference area, considering we got close to the channel high. I think down near the channel low would set up a little bit better. So one of the bright spots is high yield. You know, I have a lot of people who keep talking about this like credit crisis and we're going to get a crash. You need to see high yield roll over. High yield is really, I mean, granted, we kind of broke this very steep uptrend and we're riding the backside of it, but you really need to see this thing start taking out the 50, taking out the 100, which is roughly around these last swing lows, around 85.27-ish. Then I think you might have a little bit more, I don't know, urgency in your fear. 200 MA is kind of rising again. It's supported here. If we were to lose this low in the 100, then I think the 200 is in play. You're going to notice that as being a very constant theme throughout this video, just as a heads up. But in order to really get this kind of fear going, the credit crisis fear, excuse me, this really needs to roll over. And I think the stubborn strength in this has had a lot to do with oil. This was all caused by fear of over-levered companies with stretched balance sheets, that they were all going out of business, right, with oil. Not the case anymore with oil hanging out near the highs. Oil is a proxy for global growth. I've said here that I thought between 49s and 51s would be some resistance. We got just shy of there. Actually, I think I said 49s and 52s, actually. So we got close. We're kind of backing off. We're right on this sort of 49.33. The low of the day was 49.40. This could even pull back to retest the kind of the backside of this old downtrend, sort of this down channel, but clearly the move was to the upside. We're into some reference resistance. I don't think we're just going to keep sailing along through the highs so easy. I think that this is going to need some consolidation and chop. One of the stocks that I really enjoy playing with is ExxonMobil. I talked about selling some puts around 83.01. I actually wound up getting them off below 83.01, so I wound up kind of tagging the low. I think I actually wasn't by my computer right as it kind of, I got the alert, and then when I rushed back, it was a little bit below, and I got some off. I was looking to bring up to the position to the full size around 81s where this volume distribution is, but Exxon wound up taking off, and I didn't get on my full size, so I'd rather have a little on than not, but we got back up to sort of this other area, the kind of more breakdown level, and we've just been consolidating. So I'll use this bar. This is sort of like an emotional day bar. Anything above 87.5, you see 87.44, so this bar here, 87.5 I think is a long. Anything that really gets below this sort of pullback low here of 85.68 and the 200 MA, then I would say that this move was a little more smoke and mirrors and that we're probably going to come back down to retest the lower area. So I really like the Exxon long as 85.68 holds. The 200 is exactly 85.65. So 200 MA, pullback low. I still like it long. I would be buying a pullback even into that area. If we lose it, it's just get out of there. Above here, I think we come significantly higher back to like 90 area. Yeah, 89 is roughly the 100 MA. We'd probably get there, maybe even fill this gap right here to 90. So that's what I'm thinking. This consolidation range is the key. One of the things I've been playing long for a while, I was a little early on this trade, and I sat through a little bit of heartache, but I started selling this now for the first time on Friday for a couple of reasons. One, I believe that coal is the barometer for Trump's presidency. I know that's a little out there. I don't think it's anything more out there than people saying it's related to the Mexican peso, but this has clearly turned the corner, and we are in a up channel. So Friday, we got a bit of a gap up after a very extended move into some really key reference levels. The 50% Fibonacci retracement from this breakdown, as well as getting close to where the real breakdown took place of 12.95. So I wound up selling some at 12.42 and 12.41. I would be interested in buying this back if we got his lewd comments the other day. If there's some type of a fall off in this, I'd be interested in buying this again close to the 50 MA or somewhere near the channel low. I like that the 200 MA is now bending back up. I think the coal is through the worst of it, but channel high has been a sell for a while. I'd be looking to kind of buy a pullback into either mid-channel range or even to the lower end of the channel range. But coal I like, but I am looking now to sell some into rallies. China. So as bad as everyone wants the market to be, China is sort of just chilling. We're above the 20, we're above the 10. I think as long as this holds this 50 MA, it's okay. If we lose the 50 MA, then I think we see the channel low. So I'll keep it really that simple. I mean, if we could get over this range high, then I think we see the channel high. The high here was 39.13. I don't even think you need to use this low. I would use this kind of interim swing low here and the 50 MA as the gauge. So if there's a pullback, I think you could buy the 50 MA. If you lose it, it's a row, GTFO, meaning get the F out, or right or right out short for a move down to the channel low, which is roughly the 100 MA. Very simple. BABA is chopping. I said that I thought this area would be a little troublesome. I've been booking some profits. I know a lot of people are looking for a move to 120. Very, very possible. I ideally, believe it or not, ahead of the quarter, would love this thing to have like some kind of a pullback down to like close to the 50 MA. I don't know if we're going to get the 100 MA, but if we could get a pullback to the 50 into this area, maybe shake out some of these late to the party longs, I'd be looking to maybe play long for their earnings since they were so great the last time. I would think that they'd probably be good again. I mean, I do it with options. If they, of course, they miss, we would probably fill up the gap very quickly to 87.33 and the channel low, which would be also a right or right out play, oddly. So if we stay up high, I probably won't be putting anything back on. I'd be looking to kind of book more profits. If there's a shake and bake, then I'd probably be looking to buy long on a dip, maybe down to the trend line and the 50 MA. That would be a great confluence, particularly around these like 98s. And if it dumps, then I would probably be looking to get more aggressive down near the gap fill and the breakout area around the 86s, 87s. If you're bearish, put spreads for a move down into there. I don't think a lot of people are expecting it, and they're probably cheap. That sounds to me like a great way to play for a hedge or an outright directional play, and I may do that. I will tweet if I do something, most likely. IBB, kind of just chopping. The 200 MA has not bent back up yet. Let's zoom in a little more here. All right, 200 MA, we basically are kind of triple topping in this area, just chopping in a range. We're still above the 100 and the 200. We did break this channel, though, to the downside a bit. So you have a reference swing low here. I just think that this is going to be a choppy mess. I don't like that we're below 289.71, so I have to be a little suspicious. But this could maybe just pull back to the range low and test the backside of the old kind of downtrend line. You could see it was successfully held here. This really, to me, is just a choppy mess. I don't really think that there's much of an edge in this. And my ideal scenario would be for this to dump, basically come back to mid-range of the range it broke out from. You can see it kind of had these I don't want to say false attempts, but not convincing attempts over the breakout. So what I would love, if I had my druthers, I'd love to see this come down to, I don't think the 50 here would be enough because it's just a little bit below here. I would love the 61.8 though. Look where the big meat of this volume distribution starts here. You can see on the volume profile. By the way, this is called volume profile. You can add it in as a study on TOS. So down here near the 263s, that area was sort of like a breakout range. I would be interested in either playing put ratios, meaning buying some of these and selling 2 times out here, outright ratios, buying these and selling these, or waiting and just kind of getting long down there. So either one of those I like with regard to IBB. This Gilead is one ugly, it's sort of like Schwarzenegger in Terminator, right? I mean, in Predator, you are one ugly MF, mofo. So I drew a projection of a 1.618. I've done it two ways. One was in 71s. This one is showing it in 69s. The 50% fib of the entire move is down there around 70. I'll say this. This has kind of come down. Again, a bit of a look below and fail. A rally, couldn't get back up above this sort of breakdown, and now we're back below it again. They have earnings coming up. If this keeps dumping ahead of the earnings, I will want to play long for the earnings. If this now rallies back, your guess is as good as mine. Maybe it could get back up to the channel high, but the more days this comes down, day after day, I want to be long for the earnings. Like I said, though, if we do rally back up, it kind of screws the trade a little bit. So the ideal scenario here, look, we have an unofficial regression line. I think we're coming down into that. So I know this looks really super ugly, and I would not outright like to be long, but I would maybe with call spreads if this continues to come down ahead of the earnings, just because it'll have washed out so much. Like, you had this move up, you got probably sucked in a lot of new shorts, shook out a lot of longs. Particularly, I'd love to see the volume pick up and this to get really steep. I don't know. I don't know that we'll get it, but anyway, down in here, I would be more of a buyer than a seller. Mylan. So this was a bit of a frustrating play for me. I bought it over here. I thought this was a bit of a look below and fail. You had a couple of days of rally, and then you took out the swing low. It got me out. It turned out to be right because this closed weak, and then Friday was really nasty down again. Keep in mind, though, we were coming down from the top to the low of the range, so that's why I kind of got long. Anyway, after Friday, they came out. This wound up being like less than a point stop out, so I really didn't care. They came out and they made a deal with the Justice Department. They're back up into like 39s or 40s. So I guess now this can be construed as a look below and fail. And I think you could start buying this stock again, Mylan, back into these, on dips. I think it's kind of done. I think the rally I think it'll probably rally. Bristol Myers, I sold some puts into this area here. I've been looking to bring it up to a full position closer to 51s. So I'm just starting to build a little bit of a position. I know everyone's going to say, oh, don't add to losers. It's not really a loser. First of all, it's a winner for me now because I got this on really well. But it's my plan. Look where the volume distributions are. This is kind of where they start. This is the thick of it. So I put on a small position here and would be looking to bring it into a more full position down here. I don't like adding to losers if you're really underwater on a trade and it wasn't part of your plan to begin with. This is my plan, feeling for the bottom. The stock is down from an all-time high at 77, basically over 20-something straight points into reference lows. This was a flash crash low. So I think in this area, it should start to find some support. Okay, so that covers the 7 market keys that I've sort of added a little more onto. Let's get into SPY. We are in a way too big time frame here. Let's zoom in. I have too many alerts on this screen. I am first to admit it. Let's huddle up in this little corner here, shall we? This is my actual chart I use. Sorry that it's a little messy, but just follow my logic. If you just follow my pointer and don't get caught up in the bigger picture, I think we'll be okay. So we have a kind of a left shoulder, a mini head, and sort of a right shoulder that is below the left. I don't know that this is, I don't know if I can quite call this like really a head and shoulders. I usually like elongation in the head. But I will say this, we did have a break and we have not recovered that gap yet. And the more time we spend under there, the more likely the move will be lower. We have had a couple of instances here of breakdown attempts. First of all, we had a breakout attempt here that failed. That was last Friday. I've said for a while that the downtrend was the key, as was the 50 MA. This sold off in the last 5 minutes sort of the day, and then we've just been chopping and really just choppy and messy the whole week. So I'm going to give the same analysis. You have kind of like three little hammers here. This one was a look below and fail of this wedge. This one was again a look below and fail. If you lose these three lows, I think that this will at the very least come down to the reference lows here in the 212s. The expected move this week in SPY is $2.69. It's actually 2.691. To the upside, that would mean 217.73, which is basically a move back up to the high of a little bit above this range, probably for a gap fill. On a move down, that would be in the 212s. The caveat being that the VIX is low, so I usually, when the VIX is low, I take the expected move to the upside as sort of the max that would go. But the downside, I think, could always be more, because as you come down, the VIX expands and the expected move can expand. So I'll use this day's range. This was the kind of the big show. We need to get above the 50 MA and need to clear these days. If you can do that, then I think the move is to the upside, not only to fill the gap, but it moved back up to the old all-time high, and probably beyond, actually. What I think you'll do is double this range. The range is $7.29. A move to the upside would be to 224.82. So if we clear this range, I think we double it back up to 220. Obviously, we would get a test of the old all-time high. And my guess, considering we're down near this low, we would go at least to the mid-channel here, which would be to the 224s. The bad news, if we lose, I should say the bad news is if you're long. I mean, if you're short, this would be the bad news. If you're long, the bad news to the downside, I think if you lose these lows, we come down and at least retest these lows. You have the 100 MA roughly around here. So these double bottoms here, this is 114.04. This is 113.99. So if you lose this 114-ish area, then I think I don't know if the 100 MA would hold again. It's really up to the 100 MA, honestly. These lows and the 100 MA. If you lose that, I think we come down and see these lows. And if this breaks, then I think we're going to see the 211, the 210, which is roughly the gap fill, and this 50% fib, which is 209. But if that doesn't hold it, then I think we're coming down to the 205, somewhere between the 205s and the 206s. The 200 MA is roughly there. Remember what I said earlier? If we lose 100 MAs, I think we target 200 MAs. If you double this range, that roughly is 205.02. Roughly around the 200 MA and roughly around what the equivalent of the Brexit move would be. So if you lose this range, the 100 MA and this range, I think this is where we start to target. And I would like doing either outright short below these lows. I don't necessarily know if you have to wait for these lows, but if you lose the 214s, and you would come down to here, that's the channel low, and that would be, I guess you could cover a little or wait and see. If you lose here, I think it accelerates down to the 210s to 211s. This area, I just can tell you from past options expirations and experience, was a mofo to get through. I'm trying to keep this as clean as possible. But that area was a huge point of contention. It's the next distribution, and I don't know that we're going to get through it with as much ease as I think the shorts would like. I think that this would at least be a pause level. So I think that would be the play. A break here gets you down to here, and if you really cascade, then I think the end goal would be down to the 200 MA. So I really need to see how this range breaks. To the upside here, through the 50 MA and through these highs, I think we get the old all-time highs in 224s. If we lose these lows, I think we see these lows. And if we lose these lows, I think we get down to here. I hope that made sense. IWM, still kind of holding around this 50 MA. You have a kind of a reference swing low. If this were to lose really this day's low, I would be targeting the channel low, which is roughly here. It's also the 100 MA. So that's my thinking with IWM. Anything above this, like 1, 2, 3, 4, 5, 6, 7, 8, 9-day consolidation, I don't think that these highs would hold it. I think we'd re-see these highs and probably see new highs, probably up to the channel high. So yeah, this is very key. If you lose this like area, I think we could come down to this area where we'd see the 100 MA and the channel low. This is a must hold, because if you lose this swing low and a channel low and 100 MA, a lot of people are going to say double top, which is confirmed by the swing low in between them, and the top is in, and this could get down to the 200 MA very, very easily, which is sort of where this leg began. The Qs. Now the Qs are the strongest of the strong. This is like basically all-time highs here. Above, roughly on the 10, above the 20, above the 50, which held the last time. So this is basically almost a mini secure low, which went higher. There's a lot of reference support in the Qs here. You have the breakout of the 115.75. You have the 50 MA. So I'll keep it simple like this. You could see this was like the consolidation low, 116.55. The 50 MA is 117.14. This area is the must hold. If you lose this, then I think we would probably come down and retest this low, and maybe even this sort of breakout area of the 111s, high 111s, which would be a bit of a problem. But again, 50 MA, as long as we hold the 50 MA, I'd rather be long the Qs than short or out. So 50 MA and this low, this kind of swing low here of the 116.55, as long as that holds, it's okay. Below is not okay. With all the down moves, the Apple has been holding rather well. This looks like a bull flag to me. We crossed over and held over now this sort of downtrend line. I said here, as long as we hold the 112.39 to roughly like the 111s here, this low is 111.55, the play is long. If you lose the 111.55, it's a right or right out short to the 50 MA at the least. I love that the 50 MA is riding the channel low, so it makes things very clean to me. I like the idea that this is playing a lot of catch-up. You now have the 100 MA coming back up through the 200. The 200 is starting to turn. I was really hoping Apple would have more of a pullback before their quarter. Just not happening. Yeah, I mean, look where the 50 is. It's roughly around the one. I just don't see a lot of downside in this unless the market really falls apart. I mean, this was the breakout. So, yeah, I mean, this would be my target to the downside, the 109s, 110s, if this were to fall out of bed. There's really not that much going on there. I think that Apple is going to be in a bit of a holding pattern, unless there's some kind of a larger market pullback into the quarter. Facebook just kind of holding tough. This, to me, looks a little susceptible to a larger break ahead of the quarter, which is sort of what I have my fingers crossed for. But as long as we're above 128.33, and the 50 MA, which is roughly around this swing low here, 126s, and kind of this breakout of this candle, the play is still either no position or still hold the long. Longer term, I think Facebook is going significantly higher, but before their earnings, I always love when there's a bit of a shake and bake to the trend line. There's not much in terms of juice here. If you're playing it, you're in a consolidated triangle. I'd either wait for the break up to fill up to the old all-time high, or a break below to fill to at least the 123s, and maybe even this sort of breakout area, which is the 120.79. I love that is coinciding with the trend, with the channel, really. So that's my take on Facebook. There's just not all that much doing at the moment until there is a break of that consolidation area. So much speculation in Twitter. Got up to the 125s, now almost filling the gap. 50 MA here is kind of key. You have a 2-day range. If you lose that low, then I think we fill to the kind of trend and to the gap fill, which is 118.63. What can I say? I don't think the stock is a sell down here. It had the rally, it gave it back, but it seems to me that there was a lot of reporting that the deal is dead, right? I mean, look where this volume distribution is. This is sort of like a check back. So I still think it's kind of okay. We're at a 50% pullback. So, and basically the gap fill would be the 61.8. So somewhere in these 18s and 19s, I think the stock should support. So this is my thesis on Twitter. There's two scenarios here. One is they get the takeover and the stock goes significantly higher, or two, it becomes Yahoo 2.0 and it just is going to languish for a while in a large range. I know there was a lot of reporting on Thursday that there were no more bidders, or that Google and Disney had pulled their teams. That seems a little silly to me. Why would a company that's bidding for a stock that everyone now knows in play is up, why would they admit that they're looking at the stock? It's only going to put the price up higher on themselves. If anything, they're better to deny it, let the stock come down, put some pressure on the management, and get a better price. So I don't really, I think that where there's smoke, there's fire. I think there's some people sniffing around. So I wouldn't say, I don't think that the deal is dead just yet. This area has been a big point of contention. I actually think buying something down here for a right or right out play somewhere in these fibs is actually the right play. If you're long already, I wouldn't be adding though. Amazon, the curious case of Amazon. So let me go into a longer term time frame here to show you the scope of Amazon. If you measure Amazon from this low where the run started to this high, it was a 411.19 run. If you go from this pullback low and project that higher, it takes you to 885.19. If you take this range, 696.44, to this reference low here of 774, and you project a 1.618 Fibonacci extension higher, that is 833.91. That to me means Amazon is in the last stages of this up move. That doesn't mean it's immediate of a short. I'm actually more inclined to buy this thing on a dip, but the last time this had a pullback, it was a 222 point pullback, which is a lot. That could be a retest of the breakout, which would be amazing if it coincided with the 200-day moving average, even better. So I've said for a while on pops here, it's a good idea now that we've finally achieved our price targets to probably take some profits in Amazon. If this dumps on earnings, I'd be looking for that larger pullback. I'll discuss it if and when it happens, where I'd be looking to buy. Or the ideal scenario would be a pullback ahead of the earnings, the shake and bake. And then it kind of has a move up either to a lower high or the higher high. And I'll discuss that too at the time. But as of right now, rallies in Amazon, I like booking profits or hedging at the very least. Don't be too greedy and don't be a pig. Trade location matters. Last Friday, I said that we closed above the 200 MA, and anything above the 200 MA, I like the Netflix. I got into the stock, and it has been performing rather well. Moved up. It's been consolidating. As long as we hold over 133, well, let's use this area. This pullback low here was 101.86. Really, as long as you hold over 101s and 100s, I think it's kind of okay. But this area needs to hold. I'm really looking for a move up into these 108s, 110s, maybe 112s. I would love it to happen ahead of the number so I can just book it. But we'll see. We'll see how that plays out. Ideally, the move would be ahead of the number, and then I don't know what to tell you. Maybe there would be a pullback to the 50 and the 200 MA, which when there's a lot of confluence of moving averages, I like buying either buying or selling out of the money puts, because I think that number is key. The 200 MA broke out. I would think that a check back would be support, but I think that Netflix can maybe fill the gap here, and I'm hoping it does it before the earnings, since I want to be out. That's really the trade. Google has their earnings coming up. I've said for a while I think Google is going to get the channel high. Look at where the earnings are, look where the channel high is, and look where the 1.618 Fibonacci extension is, 895. I'm thinking that that could happen, actually. It's roughly holding the 50 MA. Let me zoom out. Getting a little ahead of myself here. As we're holding the 50 MA, I kind of like that. If you lose this swing low here, the 897, this could traverse back down to the lower end of the range, maybe even fill the gap. But I'm thinking that Google probably is going to want higher. We'll have to see how that plays out. If it starts moving hard ahead of the number, the risk reward doesn't pan out as well. But this, again, like I said, look at this. This was a look below and fail. This is a classic island reversal. It moved to the high of the range, and it's just been working off some of that excess. It looks to me like consolidation before the next leg higher. I might have some egg on my face with that one, but to me it looks all right. These were the areas I said that I thought Tesla could rally to, the 200 MA. That was what held it in the last earnings, the after-hours gap down. It is now resistance, and we're coming back down. Until they get their secondary priced for the Solar City deal, and when Elon Musk messaged that, or he messaged that they'd have to do some type of a capital raise, he should have just effing done it. The stock would be much higher by now. The shorts are holding on. This stock, I don't think, is going to be able to significantly rally until that happens. So that's my story. I don't know if it's going to go up a lot or down a lot. I like selling out of the money strangles, but I just think that the stock is going to have a tremendous overhead until that happens. Last week in the review, I said I like the channel low or somewhere around 97.02 for a long. Came up, and they now did a secondary, and we're coming back down. We're right on the 50. This is very key area. If you lose this 97.02, I don't want to freak anyone out, but I think that this would probably fill the gap to this 67 area. Somewhere in the 77s to 65s, this area. The 100 MA is down here, and the gap fill is down here, and this would be kind of the head and shoulders playing out. I think I've said it before. I think the easy money was made in this stock when it kind of doubled the range. I don't love it now. They did a secondary. There's probably going to be more. We'll see what happens with their number. The ideal scenario here would be for this thing to pull back significantly and probably be long for their earnings. They were pretty good the last time. The play might be a come down, and then it would probably rally ahead of the number. But I'm kind of disavowing all knowledge of this stock at this point. I think we got the bounce, filled the gap, and now I don't really want much to do with it. I don't. Same kind of thing with this Twilio. Oh, we froze? Seriously? How annoying. Anyway, the other bedfellow that kind of goes with this is this Twilio. They are right on the trend. This is a must-hold area. I kind of disavowed. I said I didn't like it. Up here, this was the time to book profits. It had a honey of a pullback. I said that for a right-out trade, I liked it over the downtrend line. It came back up, got even higher, the channel high. Now we're at the channel low. So let's keep it simple, stupid. Below 59.27, it's a right-out short, probably to the 50 MA. Above the high, the 61.98, it could be a move back to the upside. I will say this. They also are doing a secondary. Insiders are selling their shares. They're not issuing more shares. Of course they are. The stock is up huge. Just watch the channel. If that snaps, I don't know what to tell you. A 50 MA and maybe a move down to this reference low in the 52s would probably be the next target. That's also kind of the volume distribution down here in these lower 50s. So if you come all the way down there quick, that would be the ideal scenario. I think you could probably sell either some out of the money puts or just buy it down there. But if you snap the trend here, I think at the very least it would probably want to see that 50. PayPal is one I like. It's still struggling in these 49s. I actually sold this really well on, it sold at 41.10. I don't remember which day it was. It might have been this day. I think it was this day because the high of day here was 41. Yeah, this was it, 41.14. I tweeted it out. I had sold the 41.10, and then on the pullback, I sold some out of the money puts. I think 37s, 38s. It's just marking time. As long as it holds above this kind of last swing low, which was 39.38 to like 40-ish area, I think it's okay. They have their numbers coming up. It had run up really hard ahead of their numbers the last time and then came down. I don't know if that's going to be the case again. I know MasterCard and Visa have deals with them now where they're paying. Initially, that was taken as not so good, but I think it actually is good. I'm looking for this stock to get, honestly, I'm looking for it to get to 46.11. We'll see what happens when their earnings come up. But I like buying the dip in this stock when it comes down to like this 200 MA area. Look, you can see here it held. That was when they reported. Here it held roughly below. So around the 200 MA, which is roughly around where I have those put short. I like the idea of kind of selling it out on rallies and buying it back down near the lows. But longer term, I think PayPal will do well and actually potentially a takeover target. TASR, getting into some key levels. We're on right a little bit below trend. I think between the 50% fib and this sort of breakout area, 21s, is probably where the some support will come into play. If not, maybe it sees the full 61.8 down at 1990. But somewhere in this area, which is like near the 200 MA, I think down in here is probably a good idea to start selling some out of the money puts. I mean, if this thing really collapses, it could come back down to the 17s, but I want to start selling some puts as we get into this lower area just because it's come down so hard so fast. My only concern, and I want to say this, is do it small, because the reason they're down is because another company scooped the New York Police Department contract with a bid for like $20 a unit a month, as opposed to what TASR charges is $40 a month. The fear is a lot of other municipalities are gonna try and use this deal to haggle with TASR, and if their product margins are cut in half, that could be a really big problem for the stock. So I'm gonna cautiously try some right or right out trades down in here. Bigger picture, I think that they have a huge growing market and that they're gonna do fine, but this seems to be the pattern of this stock. It runs up hard, it comes down hard. So I tend to like to kind of buy it when it comes down. Look where the breakout really took place from here, the 200 MA. So it should technically support on the way down. That's roughly around 21.85. The 50% fib is 21.86, and the neckline that from the way back when is 21.38. So let's see. One I've been in for a while was on the breakout of this false head and shoulders. I've been looking to double this range to the upside. We are really getting close to 21.47. The real breakdown, let me show you on a longer term chart. 3 years really ought to be enough, but it might be overkill. Look where this breakdown took place, 31.87. 2 times this range here, just added up, is 21.47. So somewhere in here in the channel high, I'm looking to call it quits on CSX. Gap stores, I got told everyone I was getting long. I tweeted it out. I know a couple of people did it with me. I actually bought stock on the channel low and the gap fill, and it worked immediately, which is always good. And then we had this kind of gap and go, which was great, that their comp store numbers were down, but not as down as much as they were supposed to be. I think that was what the story was, if I recall properly. Anyhow, the move here is roughly about $10. If you project that off of the 21, that should take it up to like 31. Look where these reference highs were, 30 half, 31. There'll be some resistance in the 27s. That's where it happened the last time, but I like that it's off of a higher low, and we'll probably get a move into the channel high. I'll be looking to sell somewhere between the channel high and that 31-ish area. I think that this is kind of a professional gap. It was a gap and go above the 50 MA. Look at the last time it was a gap and go above the 50. It kind of ran well. The 200 was resistance. It's above there, so I like it. If you start losing really more than half of the bar here, then it starts getting a little more iffy. So if like Monday it's down a little, and it kind of forms a doji, a couple of days of consolidation, that to me is okay. I don't really need it to go right away, and of course I have great trade locations, so I'm really trying to stick with this one. Gap. Deutsche Bank, I don't really know what to say about this thing other than they're going to have to raise capital. There's been a lot of rumors the last couple of Fridays. This was a look at below and fail I mentioned, and now it's back to the upside, roughly to the 50 MA. This could get up to 14s and maybe even up to like 15, 16, but we're going to have to see. I don't know. I don't want to say that the worst of that, they're through the worst of it or whatever, but as long as it's above 12.5, I think it's kind of okay. Below there to me would get a little more iffy again. So Deutsche Bank, I'm just sort of watching that unfold. Wells Fargo, this is, again, from the top of the range. It was a bit of a false breakdown. And I don't know that this is going to be, that they're through I don't want to say that they're through the worst of it, but you do have basically double bottoms here by a penny, and it's now moved back higher. How high can it go? Maybe 47s. That's really where the volume comes into play. 47s, 48s. That would kind of be near where the gap fill is in the 61.8. So you have 2 days of consolidation, and you could play long over the 2-day high, which is, let's see, 45, 45. I always love when they're back-to-back numbers. So long over 45, 45. And you could use 44.83-ish. What's the low here? 44.93. So 44.83 as a stop. If it were to like break out and then you lose these, it could be a stop. Anything below these 2-day lows, then I think it is going to kind of come back down. So I like it right or right out long above the 2-day high, or right or right out short below the 2-day low. Keep it real simple. Chipotle, they have earnings coming up. I honestly don't play this stock for earnings. I had a very bad experience with this stock once on earnings. I did a strangle on it, and it wound up being a really big problem for me. So I don't F around with this thing around earnings. I do like to play it after earnings, though. This was the last time they had earnings. They had terrible numbers. The stock rallied up for 1 day, got into the kind of the old high resistance. It came back down to the end of the range, got back up, back down. This is just nauseating. I'll tell you this. There's 2 trades that I like with this stock. If you get above the last earnings high, which would be a range breakout, which is above 44.13. Like if this were to gap up, it, in my view, will be a gap and go. So you want to be long the stock. If this is to like gap below this range low, I don't know how much steam it'll get, but you don't want to be long, and you probably would want to be short the stock to as much as even 312. That is my view. I really want to be the second mouse with this stock. So if it gets above this high, I like it long. If it gets below the lows, then I like it short. You're just in a range, Until that range breaks, I think it's just pure out gambling. I'll end it there. I was going to do a couple more, but I want to keep the video a little shorter. If you're not following me on Twitter, my handle is @JustinPulitzer. Be sure to follow me. If you like this video, please leave some comments. Hit the thumbs up. If you're not subscribed to my YouTube channel, hit the subscribe button. There's also a little bell with a ding or whatever there. You'll get notifications when I post new videos. I encourage people to check that. Anyhow, that's my story. I'm sticking to it. Let's enjoy the debates on Sunday and have a great week. Cheers.